Hello and welcome to the next 100 Days podcast. My name is Graham Arrowsmith.
And my name's Kevin Appleby. Well, Graham, you've left big corporate, you've set up your own business, you've
Mhm,
possibly got to the stage that you and I are at and thinking
mhm.
about can we ever possibly afford to retire? And you might be thinking, oh, I wish I might have taken some financial advice. What should I be doing to be able to afford the rest of my life? Um, I think we've got somebody who can help us with that today.
Oh, we definitely have. He's really well known, and he's got his own podcast as well, and his name is Alan Smith. Alan, welcome to the next 100 Days podcast.
Thank you for having me. Good to be here.
Now, you've got a particular accent, and I really want to place it, but it sounds southwestern. But tell us where you're from.
Southwestern? No, I'm from Scotland. I'm actually from the southwest of Scotland, if that helps.
Well, that's what I meant.
But
Yeah, that's what I
I,
meant.
yeah, obviously, I've been down south. I've been living in London 30 odd years. That's probably taken the rough edges off.
Right.
But yeah, it's a bit of
The
a mixed
southwest of
accent.
Scotland, that must be Robbie Burns' country.
Yeah, exactly.
Yeah.
Pretty near there. I'm from a small town called Troon, Troon, which known
Oh,
to
no.
nobody other than golf. We've got the
Oh,
Open on there this year. So every 7 or 8 years, the entire world descends
Yeah.
on this town of 12,000 population, and the place goes nuts. And
Yeah.
then no one hears about us again for another decade or so.
No, I know Troon.
My,
And
my daughter was at university in somewhere slightly more famous for golf in Scotland, but St Andrews, but the same sort of thing. Tiny town where the
Yeah,
whole world seems to descend on it if there's a big tournament on.
yeah.
exactly right. Scotland's full of them.
And it's a lovely place to go. I want to ask you the first question, which is um, recently you issued this sort of how I invest my own money, and you had a couple of things in there that really stuck out for me. One which was family fortress, and the other one was investment playpen. Can you explain to our listeners what you mean by those and why it's maybe important to them?
Okay, thanks, and thanks for noticing. Yeah, that was just the other day that I posted that. This is something that I often do in social media. It's swirling around in my mind. I'm doing something, and I think, I wonder if anyone else would find this helpful. Sometimes you send things out and it's tumbleweed and you don't get much engagement, but that one seemed to be quite
No, that
popular.
will.
And I think the background to that is because I've been doing this, man and boy. I'm, by any stretch of the imagination, I would be considered an expert in all matters personal finance. And like a lot of things in life, it's quite interesting to learn possibly what someone who advises lots and lots of other people to do with their own money, what do they do for themselves?
Mm.
And so I broke it down in detail. I'm happy to go through it to the depending on how interesting it is. The key thing is it's very, very simple. The idea of the family fortress is this: look, at the end of the day, all of us are either have achieved or aspiring towards achieving this magical thing called financial independence,
Mm.
financial freedom. Some people call it retirement. Some people I know could have retired years ago, but they carry on working. But working is optional. They've got enough money in the bank, money in savings, whatever, to generate sufficient free cash flow to support their lifestyle, however that is. Okay, so that's just a version. That's what we all hope to achieve. And if we do achieve it, we want to maintain it. We never want to go back from that position. So that requires an investment strategy. It requires a number of things, which again, I could break down for you in a moment or two. But if we go straight to the investment strategy, so that's what I call my family fortress. That's the stuff that I'm really relying on. I will
Mm.
be relying on that in the future, in years to come, to build a capital value and to generate an income so that I don't have to show up anywhere at any time and swap my time for money.
Mm.
And so therefore I take what I would consider to be a low risk. And again, happy to talk about risk because I've got a very different definition of risk to that a lot of other people, the media, the press, and some of the industry that I work in consider to be risk as well. So I want to be low risk. I want to be diversified. I want to be simple, effective, low cost, all those good things. I want to be tax efficient. So that's my family fortress. And that's what I'm continuing to build such that I can achieve financial freedom, financial independence, and have a work optional lifestyle.
Mm.
However, and not everyone will have the same sort of views or appetite, but I've just got and a few of our clients have this as well. I've got an appetite for things that maybe a little bit more racy, a bit more fun, a bit more interesting than the dull and boring long-term, buy and hold investment strategy. So that's what I've now called the investment playpen. So it's like chuck a few things in there, bit of fun, something you thought could be quite interesting. Look, you put so little relatively in there that if it all goes belly up and you get completely wiped out, it's not going to make a significant impact to your future finances. If it goes well, happy days. So it's a bit of a playpen, and I've got a couple of, kind of high risk investments. I invest in a couple of startup companies, early stage businesses. And I've got even a little bit, and I dread to say it publicly. Well, I did say it publicly on LinkedIn the other day. I've got a little bit of Bitcoin in there as well. I don't believe in Bitcoin particularly as a thoughtful investment strategy, but I'll chuck a bit in. Just to see what it's like to to buy cryptocurrency. The process.
It's not like admitting to sniffing coke, is it? I mean, at the end of the day, you're invested in Bitcoin. I mean, it's not the end of the world.
Well, it does run contrary to our core investment philosophy. We've got a very thoughtful, academic-based investment philosophy here, and just to admit that I've sort of broken ranks with my own rules is a bit funny. But as I say, the amounts are so small. If it went to zero, I'd go, oh well, there you go. It was a lot of rubbish after all. And if it does what some experts, so-called experts, are saying, then happy days. So that's the concept. That's basically the concept. What people should focus on is the family fortress.
Sure.
It's only just, a few people just like a bit of fun, a bit of sort of side investing. It's almost like going to the casino or a day of the races or something like that. Yeah. A bit of fun, and if you make money, good.
And if you had to split those in terms of 100%, presumably the former is going to be sorry, forgive me.
It would be 95-5 approximately
95
in percentage terms. You want the vast majority, if not 100%, the vast majority of your money, your savings, your investments in a very carefully thought through, investment strategy based on rigorous academic research, all those good things. Yeah. The thing about the investment world is it's a bit like we were talking before we switched on the mics. We're talking briefly about football, for example. And investment's a bit like football or politics or religion, anything like that, because everyone's got an opinion, right? Yeah. And a lot of the opinions are wrong when matched against the rigorous empirical academic data. And that's where we build our investment philosophy on, not from what the guy at the stockbroker or the fund manager in the City of London tells you, because he's got a vested interest in telling you something. But what does the Nobel Prize winners for economics, what do they say? What is the academic research coming out of Oxford University, Chicago School of Finance, these places where there's deep academic research and learning? And so that our entire investment philosophy, the family fortress for me and for pretty much all our clients, is based on that.
Isn't it true though that the family fortress, isn't it a good strategy to be thinking about indexing your money to, say, the S&P 500? Because over time it seems to outperform managed investments, and you think, how the heck can that be the case? But at the end of the day, it's investing in the greatest companies there are, and their performance. So it's a weighted basket that seems to do well every year.
Well, what an index does, it simply gives you the return. If you know what an index actually is, an index is just exactly that. It's a basket of whatever securities, companies, bonds, whatever the index actually is. So the S&P 500 that you mentioned is simply a fund that you could invest in that gives you a market cap weighted, which means that it's the amount that you own is in the same percentage terms as the company's value in relation to all the others. So, the biggest company in the world, well, until recently, was Apple, and I think Microsoft have overtaken them. So you have a little bit more of Apple and Microsoft and a little bit less of the other smaller companies. The S&P 500 is one, obviously, the sort of top 500 companies in the US. I would say that would be a good place to start, possibly. It's a little bit too focused on one economy. The US economy has been, racing away for the last decade or two. But there's no guarantee it always will do. So again, we would be fans of being more globally diversified in terms of your allocation. But you're absolutely right. 20 years more than that, 30 years plus in financial services, 20 years running my business, working with successful entrepreneurs and business owners as clients. And we've gone through, a very detailed process over the years. We need to learn this stuff ourselves in order to give advice. And there's now no question, based on all, any number of, research papers, that the vast majority of what you call active fund managers fail to beat the index. So and one of the reasons is costs, fees and charges. Some of them are pretty smart, but once you knock off all their fees and costs and charges and transactions and so on, then you'd have been better off simply buying an index fund, super cheap, and then buying, holding it, and keeping it.
Yeah.
But it's probably worth me just backing up a bit, because in terms of this whole idea, the investment side is one thing. But before you even get to the investment aspect, you need to decide, you need to sort of go back a stage and say, what are we trying to do here? So again, for the benefit of, and again, we just speaking a moment or two ago, Graham, even thinking about your own circumstances.
Yeah.
What happens is everyone gets sort of caught up in the frenzy of all the excitement of stocks and bonds, and currently, Nvidia's racing away, or Tesla stock or something like that, because that's the racy stuff which captures the newspaper headlines or website attention. The important thing is to go back and understand why are you investing? What is the purpose? What is the point of you investing at all? Because investing is simply deferred consumption, right? You could have whatever money it is, just spend it. You can just go and enjoy it, go on an extra holiday, buy another car, do whatever you want. But people choose not to. They choose to invest and save and defer that consumption. So the big question is, why are you doing that? Now, of course, we said earlier on, well, it's to build a good retirement. But in order to really be smart about this, we need to get into some detail. So I just want to outline, it's basically a three-stage plan, three-stage process, I should say. We've distilled all the work we do, which in some ways can be very complex. There's a lot of moving parts going on, but we've just distilled everything down to what we call the 3 Ps. And this is what everyone should start by thinking about and start by doing. The first P is the plan.
Right.
So the plan is really, it should start with a good conversation with a good financial advisor, wealth advisor. And they should be asking you, before they start talking about all the funds and everything else, you say, well, what is a life, what does a future life look like to you, ideally?
Yeah.
When do you want to stop working? Do you want to stop working? Where do you want to live? What sort of holidays you want to go on? Are you going to change your car regularly? Do you have any kids you need to help out? All those sort of things. We need to really have good quality conversation where an experienced advisor will be able to ask you a huge number of questions, some of which you'll have thought about yourself. Some you'll even have the answer to quite quickly. And some you probably will never even thought about before. But you want to get that all out of your head and then get it into some sort of format. Now, we call that, generically called our financial plan.
Mm-hmm.
Here at Capital, my firm, we call it a future map, because it's exactly that. It's a map of your future. Yeah. And it's documented. Good firms will use quite sophisticated software, and we're going to just what I call stress test the future. And we say, look, in order for you to achieve the lifestyle that you've just told me you're aspiring to have in X years, we're going to be date specific as well. It can't be, I'm going to retire sometime. Because it won't tie you down to the actual day, but is it when you're 65? Is it when you're 67? Is it, tomorrow? When's the time span? How long have we got? And then using some of these modeling tools, we can say, in order for you to be able to successfully achieve financial independence, you need X in your pot. Let's have a look at what you've got. Oh, you haven't quite got there. So now we need to begin. Then we go on to the investment side of things. We say, right, we've got to bridge that gap. So this is the best ways of doing it. So you invest, you become very tax efficient, and you begin to, you're off on your journey then towards financial independence.
That's great for the sort of, I don't know, the 30, 40-year-old, my kids, for instance. Good advice, great advice. For the guy who's, lived through that, saved a fair bit, I'm thinking about myself, and basically at the end of the day, I'm 4 months from 65. Now, anybody looking at me thinks, no, he can't be out of his 30s, but not truthfully, I'm 4 months away from 65. But the thing is, there are plans there are pensions already being paid. But I heard Dave Ramsey this morning, and he was reacting to another guy, and some other guy was commenting on his reaction. And basically, it was very much about how much do you drag out of your pension each year, these drawdown things? So
Hmm.
when it comes to the plan,
Yep.
kind of got the plan, probably don't want to take something for the next, I don't know, 3 years, but then my wife catches up to me and we can perhaps retire together, sort of thing. That idea. So that's part of the thinking. But Ramsey says, oh, you can take anything. The growth rate in money has been around 12% per annum. Take off 4 for inflation. You can take 8. And his daughter, who was on the same podcast, was, I'm not so sure, Dad, sort of thing. Maybe 6. This is all kind of Greek to me at the moment, and
Yeah.
because I've not lived it. Um, when does that sort of calculation come into it, Alan? Does it? I mean, we are talking about the P. What are you going to do?
Yeah. The
And those
plan.
listening to this are thinking, yeah, okay, I've got a few things to sort out. If I'm 30, then maybe there's some of those things I'm going to answer over the next 30 years. But if you're me, you've got to got most of these things you've got to have got clear.
Um, well, again, hopefully, but here's the thing. This is not a sort of a once and done that when you turn 65, everything is rosy. You never need to think about this again.
No.
This is a rest of your life program. And that's why, as we know, life expectancy is getting longer and longer. People are living well into their 80s and 90s and beyond nowadays. By the time you or I reach our 80s, then who knows? Medical science might have improved. We'll live for.
And have you ever met a Leeds fan in their 80s? I mean, they kill you off long before then.
Well,
But
maybe
no,
you're the exception, but perhaps for some of the other listeners. But the point here is you still need to be thinking about building this financial plan, this retirement model, whatever age you are, because it's designed for the rest of your life. And in fact, it's far more relevant for people at or close to the retirement age. If you're 30 odd, you don't know what you're doing at the weekend, never mind what you're doing 30 years from now. So it's quite helpful to begin to build a track to run on, but it's really important to do that. So I would encourage you, in your circumstances, to begin to, get all the. It's kind of like if anyone is listening to this, if they're running a business, it's a lot of the same philosophy of running a business. So you're looking at your balance sheet, you're looking at the kind of the P&L, your money in versus money out, and you're looking at forecasts.
Yeah.
Going forward, how much do we need to, how much do I need to hit the bank account every month in order to live the life that we want to live? And some people I've met, I've got the number is a huge number because they live a particular lifestyle.
Yeah.
And some have a more modest means. It doesn't matter. Whatever your life is, your life. You choose it. So I think it's very important that anyone who's at or close to the retirement age begins to get this plan created.
Mhm.
The key thing about the plan, of course, is no sooner have you completed it than it's out of date. That's the issue because your life changes, the world changes, the economy changes, but at least you've got a framework. At least you're not sort of driving, in the dark with no headlights on. That's the thing. Investing in a vacuum without a plan is nuts, and most people do that. I'm chucking money in an ISA, I'm chucking money in a pension, and they don't know, is it too much? Is it not enough? Why you invested in that fund versus that fund? Because there's no structure or strategy to which the investment is tied to. So you build a plan, and then you got to fuel the plan. This is us getting into the investment side of things. So how are we going to create the resources in the future, which is aligned to what I've laid out within my retirement plan?
Right.
And that's when it comes down to the investment strategy. And we could talk about investments all day long. My key word on this is simplify. The investment industry just wants to complicate everything. They talk about all these weird and wonderful plans and schemes and bonds and hedge funds and everything else. 99% of it is a waste of your time and my time. Distill it all down. There are only 4 asset classes really to invest in. You can only invest in equities, which is companies. Buy a little bit of another business. You can lend your money to companies, which is bonds, or governments, which is like gilts in the UK.
Mm-hmm.
Property is another asset class. Now that can either mean bricks and mortar, you can do buy to lets and all that sort of stuff, or you can buy funds, which they themselves invest in property, and cash. So equities, bonds, property, cash. That's kind of it. And each of those has its own risk and reward spectrum. So, equities over the long term outperforms anything else by a country mile. In the short term, though, the price of that is it can be volatile. So something happens, a war breaks out in the Middle East or whatever else, the value of that equity holding is likely to fall in the short term. However, there's never been a period in history where these market falls and corrections have never recovered and the market's gone on to set a new high. So this all comes down to your appetite. Can you sleep well at night if your fund fell by 20%? That's the question. But if you're thinking, if your plan says, yeah, but I don't need this money for another 10, I need the money to pay my lifestyle next year for sure.
Yeah.
But I don't need access to all the money, all my entire pot today, tomorrow, next week. So, and I'm prepared to leave the rest of it to wait for the market recovery and make sure that I got my income requirements in place.
Does this resonate with you, Kevin?
Oh, it does, absolutely. Yes, yes. And I've always had that kind of view that equities must be the right thing to do for that very reason, that it always seems to just outperform stuff in the long term. But then again, there's bits of me that we've talked about lots of different things on this podcast in terms of investing as well. We've talked about things that have got that have had rates of return well over 10% when interest rates were next to nothing. And it strikes me that if you can find some of those that are not stupidly risky, that must be the best way to go.
We would characterize them as alternative investments. I'm not 100% sure which of the four that you would lob those in, because
I mean, those. What depends what alternative investment you mean. They'll fall under one of those categories. Often, I think they might be in the fixed interest or the bond part of a version of that, but they've got particular ways of structuring. Now, here's the thing, and again, each to their own. Everyone's got what I said earlier. Everyone's got their opinion. We've been doing this a long time. There are some basic rules. It's like rules of physics and gravity and stuff like that. There's one you can't get away from, which is risk and reward are related. Risk and return are related. If you can get 10% return when interest rates are zero, I promise you there's a high degree of underlying risk in there. There couldn't not be, because everyone would just do that. Everyone would just flow to that. If you can get a relatively risk-free return, which was a huge multiple on the risk-free return is generally considered to be money you can get from like treasuries or government gilts or cash, effectively government cash, because we hope the government can't go bust and you get your money back. So whatever the rate is, if the rate is 1 or 2, 3%, that's everything that's then the benchmark. And if you're getting 2, 3, 4, 5, 6 times that, I promise you there's a risk, whether you know it or not, whether it's inherent within the structure, but that's the way capitalism works.
Now, Alan, you said right at the start of this recording that you perhaps had a slightly different view of risk to the norm. So how does that play in here?
Yeah, I'm glad you brought that back, because a lot of people think of risk as, they say, well, the stock market is really risky. And what they're getting confused, they're confusing volatility, short-term volatility, with risk. So my definition of risk is the chances of permanent and irretrievable loss of capital. So you could put your money into something, a friend's got a new business or something, and you just give them some money to put into it, and it goes bust. That's permanent loss of capital. You ain't ever going to get that back. Whereas investing in a basket of, in my case, in the post that I put out the other day that you refer to, I've got investments in over 13,000 of the best companies in the world. Now, the chances of all the companies we mentioned, every big company you've ever heard of, all going bust at the same time, if that ever happens, we've got bigger problems. I'm not worried about my pension fund then, because the world has come to an end somehow. But as I say, risk is not volatility. The real risk, from an investment viewpoint, is inflation. Is the fact that the cost of living goes up. The cost of putting petrol in your Porsche next year is going to be more than it was today and last week, and therefore that's your enemy. Although it's kind of the silent killer of wealth, because you don't really know about it. It just exists there. You just go to the shops and what you were buying, so that's a bit expensive. And so our philosophy is to allocate your resources to the assets most likely to outpace inflation. Right. Your biggest risk, especially if we're talking about retirement planning, your biggest risk is running out of money before you run out of life. Okay? Because all these other fancy investments you might talk about, all right, well, I've got 10% here, I've got 5% here, all well and good. If you get to, I don't know, age 80 or something, you think, wow, it's all gone. I've spent it. That's a problem. So that's the key thing here is to recognize risk is is the fact that the cost of living goes up every year. The money that you are investing and saving now, you're going to need in the future. So you got to ensure it keeps pace with inflation.
Mm.
A lot of people say, I like to avoid risk. I keep my money in the bank, keep my money in the building society, because I know, you know, if I put £1,000 in there, it'll be £1,000 and a little bit more next year.
Mm.
And of course, what we know is your purchasing power, what you can buy with that same £1,000 has actually fallen in real terms after the impact of inflation and, of course, tax. So often these things are taxed as well. So that's the real risk.
That's the point that I was picking up from Dave Ramsey. What he was, and whether you agree that he can make 12% per year. If he can, then great. But then, like he said, he lobs off 4% for inflation. I think it's 3.8 in America at the moment. It's going up again, and it's about the same over here. And basically, so you know, if you're making 12, then you take off what's it called, 4, then you've got up to 8 to potentially take out of your
But
pot,
that, I mean,
whatever it is,
that's
to live on.
Ramsey. I've got kind of mixed feelings about him. I've watched a few of his things. He's mass market, isn't he? He's speaking to millions of people. He's giving generic views.
He's
And
maybe
he has
not
to say
talking to your market, but
no,
in
but he also has
fairness,
to say controversial things. If he just says like normal conservative type things, no one's interested in. So he says these nutty things. 12%. I mean, it doesn't do 12% consistently time after time. And what do you do in the years when it's down 20%? The market short-term correction. No, but here's the thing as well. These rules of thumb are exactly that, a rule of thumb. 8%. The default that most financial professionals consider is a 4% rule. That's what there's books written about that. 4% would seem a reasonable drawdown from your pot, which would keep things sustainable, which would be allowed to increase in line with inflation as time went on. However, back in the real world, and having worked with clients through all sorts of market, you know, advising clients in the great sort of financial banking crisis, 2008-9, a number of other things, what you realize is people are not robots. The fact that if the market has, if your pension portfolio has fallen, again, I keep saying temporarily, it's down. It will recover, always has done, always will do. But during that period of time, other than your necessary expenditure, just pay the, you know, the gas bill, the phone bill, the food bill, etc., you may choose to maybe curtail a few. You might tighten your belt a little bit, just for a year or two till the market recovers. The thing about financial planning is, it's an art every bit as much as it is a science. We can do the numbers, we can build the spreadsheets, build the models, and they can tell you 4%, 8%, whatever you want to talk about. And by the way, whatever people say, we will take that and we'll model that number for our clients. We'll say, if we take 8%, and if we get this sort of average market rate of returns, there's other, and we run our models through to everyone's going to live to age 100. We've got to assume something, and 100 seems like a nice round number. And there's 3 outcomes, 3 potential outcomes. You're either going to run out of money at some point, and that's, we sometimes see that. We create these nice sort of color charts and say, well, look, on current trajectory, age 79, you're going to have to maybe downsize, sell the house, do something else. The alternative is, oh no, we run it to age 100. This happens quite often as well. You've got more money than you could spend because you sort of lived a fairly frugal lifestyle. Your resources are greater than your lifestyle expenditure. So there's a challenge because you've got, how do you feel about the tax man then taking 40% of what you've got, because that's an inheritance tax bill is likely to happen using under current legislation. So knowing that, if you look like you've got surplus capital, why don't you either enjoy it, maybe, you know, go business class instead of economy class, you know, go on an extra holiday, or even better, help friends and family. Quite nice to be able to. There's a saying, it's quite nice to give with a warm heart than a cold hand, you know, rather than when you're dead. If you can determine that you've got enough money in your savings and your pot that you could comfortably give some away, help children, family members, whatever it is, and without negatively impacting your own personal plan, then that works well.
There'll be limits, Alan, that you'll be able to give to family and friends and so forth, because, you know, otherwise the government will be saying, hey, hold on a minute, chum. I mean, 40% of that was going to be mine, you know, when you're brown bread. So at the end of the day, there will be limits, won't there? You can give so much of it, or can you give more than...
You can give away as much as you want, although, again, without getting too technical here, depending on how the gift is structured, The rules, there's a thing called the 7-year rule, which you make the gift. There are a few exemptions. You can give small amounts away, and you can give you can make gifts out of income if it's not impacting on your lifestyle. But other than that, if you want to give 50 grand or whatever it is to children, you can do so. But you've got to live 7 years for it to be wholly out with your taxable estate. If you die within 7 years of making the gift, there's a chance that some of that, if not all of it, if you die quite quickly after making the gift, will be clawed back into your estate and tax would be paid. That's to avoid what they used to call deathbed planning. I'm on my last legs. I could give away all my wealth now, so the taxman doesn't get any, and my kids have got it. So 7 years seems like a reasonable time horizon to do it. But if you know that you are going to be fine to be able to do that, then that's what you wouldn't. Why wouldn't you start to do that within and get that 7-year clock ticking?
Yeah. Is it, I mean, presumably you guys with these 100, living to 100. I mean, Kevin will probably live to about 150. I mean, he's such a miserly bugger.
I'll have to before we win a league title, Graham.
He'll be living on about £2.50 a week, won't you, Kevin, back when you're 149? But
He'll be doing podcast 1000 then, won't he?
well, yeah.
That's it.
Yeah.
But,
He'll have a new course, that's for sure.
this thinking about establishing your fund, and you're dealing with a lot of entrepreneurs. Now, I'm conscious that quite a few of our listeners might be folk who have been in big corporate. They well have had at some point that final salary pension, but more recently, it's come down to a personal pension that you've
money purchase, DC.
money purchase.
Yeah.
Then you've gone out on your own, and suddenly there's been a drop of income to start off with, and probably the thing you've not done is put anything into that pension pot.
Yeah.
Then you've maybe come up and had to deal with COVID, where the business went through the floor again. And you start thinking, oh, hang on a minute. Yeah, things were going nicely. There's a bit of a gap now.
Mm-hmm.
What sort of advice do you give to people to try and recover that kind of situation?
Well, obviously, every situation is unique and different in its own way. So it would depend. This is some pretty, at its simplest level, this is just maths, which it goes back to how much do you need to pay your bills, to live your life? I keep saying that, and how much of I'll just use the word a pot. How much of a pot? It doesn't matter if it's pension, savings, whatever it might be, any resources which can generate income without you having to do anything is the key thing. How much is the pot? So all we are looking at right now is if the circumstances you've described and we haven't been able to make contributions to pensions and business has been a bit tough for a couple of years. So the pot it hasn't increased very much in recent times. So if things have improved, will you get back to saving again, investing again? I mean, pensions, as dull as they are, they're the most tax efficient method of saving for your future that exists in this country. You get some very generous tax breaks on the way in. You can get a big chunk of cash out tax-free on the way out. And the fund itself grows in a tax-free environment. So they're very valuable from a tax planning and retirement generation viewpoint. So the thing is, can you afford to top it up again? Put a bit more into it? If so, yes. This is not advice for sure, but I would be, again, alluding to my earlier conversation, I would be increasing my exposure to equities because I'm going to expect a greater return on equities. A lot of people that I come across haven't even looked at what fund they're invested in. They got the default fund when they opened their pension or they were given some advice and they haven't paid much attention to it. And it's probably a bit pedestrian. Or, some I've seen, they've sat in a cash fund for 10 years. I mean, it's just outrageous because people find this stuff. As a client said to me the other day, he said, Alan, this is what I call dull but important. He said, I find the whole thing a bit dull, but I know it's really important. And so, look at the underlying investment strategy. Look also at fees, costs, and charges in your pension account. Certainly, if someone's had one for a few years, you might be paying a lot more in cost than you need to do. A lot of the modern way is super low cost. All the things that we recommend are very low cost. And what you're trying to do is just stack the odds in your favor. If you can shave a few percentage points off the cost, if you can increase a few percentage points on your annual return by ensuring you've got the right asset allocation, and you can throw a bit more money into it if business is improving, that's all going to combine to help you towards achieving your goal and your outcome. Worst case scenario, there's still not quite enough in the pot. There's nothing else for it. You either got to have to reduce your expectations of living standards, living requirements, and as I say, maybe not go to Barbados twice a year or whatever it is, or you're going to have to extend your work period. Now, And thinking about the sort of profile of the people you just mentioned there, Kevin, retirement is very rarely nowadays a cliff edge. It's not like you go to your 65th birthday, get the gold watch, and you're playing golf on a Monday morning. It's often a phase, isn't it? It's a transition. And people, if they can, they're working, 3 days a week, 2 days a week, taking the summer off, whatever it might be, but they're still generating income but might not be as much. And so they're using savings, investments, pensions, whatever to supplement to ensure their lifestyle. So it's a phase thing. But the clear, all roads lead back to getting all this done on paper, getting it documented. What is the balance sheet looking like? Add everything up. What are you worth? What have you got? What might you get in the future? And how does that align with what I need to have?
This plan of yours, and we're going to get to 100, Alan, and let's say we're at a 60-year-old, so you got 40 years to go.
Yeah.
Your first 15 years,
yeah.
you're going to be reasonably fit if you're
Right.
fit to start off with. But after that time, you become a bit more of a hermit, and you don't like to get out. And my wife works with some 90-year-old people who, some of them post-COVID, thanks to the bloody Chinese, they won't even leave the house.
Yeah.
And it really upsets me because it's changed the way they live their lives, but they're like hermits. They just don't want to leave, and they're scared witless. Now, the thing is, that's probably part natural anyway. So you get to a certain age, and illness gets on top of you, and before you know it, you're
well, exactly. Lifestyle changes and evolves. Of course, it does. Over the years.
So do you take more money up front?
Yeah. So you're likely to do so. So everything should start with, tell me what you want to do. It shouldn't start with a spreadsheet. It should start with your life. That's the key thing. That's the differential.
Yeah.
And that's the approach that my firm takes. I have to say, a lot of the investment industry doesn't. It goes straight to, how much have you got, and what returns can we get? Let's start with you, your wife, your family. Tell me about your life, and then what you're going to be doing. So say if you're a great case study here, Graham. We just say, so in a few months, 65, you're carrying on working, you're doing other stuff. You sort of, as you say, let your wife catch up with you.
Yeah.
But you may choose to sort of slow down a bit, get into your late 60s, possibly. So then you're sort of doing the numbers about the finances. But hopefully, and you look very fit and healthy. I wouldn't say you're a day over 35 from where I can see, but you are.
You need to go to Specsavers.
It's already been.
There's 3 phases. Again, these are just headlines, generic. This is a rule of thumb. Every situation is different. You're entering to your go-go years. Okay, these are the go-go years.
Yeah.
The next phrase when you get
down a nightclub.
Could be. He could do wherever he wants. I don't want to talk about his personal life, but
Go-go
years. Then followed by the slow go years, slowing things down a bit. Then there's the no-go years, which is your 90-year-old who just doesn't want to go anywhere. Go, slow go, no go. Right. Yeah. But really, you're exactly right. We've worked with loads of clients over the years. This kind of 65 to 70, depends on health and fitness and the rest of it. 80, it could be.
Yeah.
You want to travel, you want to hop on and off planes and get on boats and, get on a bicycle, have a bit of fun, that sort of thing.
Yeah.
Most people, by the time, there are obviously exceptions to the rule. I mean, my dad's 83, still just cracking on. He's out with his dogs every day and doing things. But for many people, getting into your 80s, you're definitely slowing down a bit. You don't quite fancy that trip to Australia to see the grandkids or whatever it might be. And later on, you're right, health care becomes more of an issue.
Yeah.
So, and then of course, but from a financial viewpoint, you do need to balance that. The costs of, God forbid, if you have to go into a care home and you don't want to go into the local authority care home, you want to have to pay for it. They're not cheap, these things. So being alive to that as well, that's what I'm saying. It's an art as well as a science. But for sure, those first 10 years post-retirement or phased retirement have the time of your life. If you've got you should be in a situation where you've got enough resources and enough time and hopefully the health to do all the things you never had the chance to do, while you were working and, saving and building a business.
It's a shame that we couldn't have done it in our 30s,
retire.
And spent all that money traveling the world and sob the rest of them. But no, we had to bring kids up. And, we've probably all been through it. So basically from that point of view, I And certainly it's within our plan. I mean, I noticed on your website, just anybody wants to know more about Alan, you can actually find out more about him at his website, which is a brilliant website. He must have got it years ago. It's capital.co.uk.
It is, yeah.
And yeah, I mean, crikey, I mean, what a name to secure. I mean,
Yeah,
unless you
I
paid a
bought the domain
fortune for
name.
it.
Yeah, I paid a few quid for it, but
Yeah,
it wasn't a fortune. But no, it's a good memorable name. If anyone wants to learn more about what we do, just yeah, you can find that capital.co.uk. Very
yeah. I
good. But
mean,
yeah, that's what we do. We help people sort of live a fulfilled life, of
yeah.
financial independence and freedom.
I've met a lot of financial advisors. I dabbled in a business in and around that space,
Yeah.
and most of them are really nice people. Most of them are really, really nice people. There are a few probably just see how much money you can make for me, and but that's the same in any
The,
group.
the, the, the industry, or the profession as we now like to call it, has cleaned its act up a lot in the last
Mm,
decade or so. A lot of back in 2012, 2013, there's a sweeping legislation was brought in, qualifications had to increase, commissions were banned,
yeah.
all that good stuff. So of course there's a few cowboys. There is in every profession,
Oh,
but the vast majority of the people that I meet are well intentioned and pretty good.
yeah. I mean, uh, Kevin, you're on the finance side. It's not quite the same as financial advice.
Mm.
So basically, you're just like me in this respect. You're going to be a consumer of those services. Yeah.
Yeah, absolutely. And that, yeah, I have a finance background as an accountant. Part of running a business that is providing networking and training for other finance leaders. But we're talking all the time about finance when it comes to companies.
Yeah.
We're talking about going through fundraising, angel investors going to seed, going on to Series A, Series B, Series C. We're talking about exit planning for businesses. We're really, really good at all talking about all of that sort of stuff, but we never talk about personal finance. So I'm finding this conversation fascinating.
Yeah, that's the thing, and it's very common. And this is the other thing as well that I find. Our office is in the City of London, so we're surrounded by financial experts and financial professionals, and yet quite a number of our clients are exactly those people. And they come and I think sometimes they, well, you know all this stuff, but the key difference is they're not objective when it comes to your own finances. You're emotionally wrapped up in the choices and the decisions that you take. And the value of having a third party, a professional, that as a, just as a sounding board, just to say, well, that's quite a good idea. Or no, I wouldn't do that. Or I'll tell you another client I worked with last year, he was thinking of something similar. And just the value of doing that, regardless of levels of expertise. As I say, some of the most smart, sophisticated professionals enjoy the idea of just having this trusted advisor, confidant, a coach. And if you deal with good financial planners, they should be operating really at the intersection of money and life. That's the thing. If it's all about the money, you've got the wrong financial advisor.
Is you? I mean, you're there, right, in the city of London.
Yeah.
You you've got all this experience. I can
Mm.
understand why people turn to you. You're a very credible individual, and if your team are like that, then you're going to do
They're
really
much better than me.
well. I mean, I didn't want to say that, but at the end of the day, though, you're actually providing that service. Earlier, you said that general. I think this is what I took. You might not have said it this way, but general fees are reducing.
Mm.
You said yourself in terms you put the objective is to try and get as lower set of fees as possible. Because frankly, that's just like inflation. I mean, all right, you're paying for it, but at the end of the day, you're paying for a bit of advice. So what kind of fees level would you advise? Maybe a difficult question that, but
Well,
what?
yeah, it is a bit how long's a piece of string. I mean, there's
Yeah,
what you are thinking about doing is there's two, if not three, component parts to financial advice. Whatever. One is hiring a professional. So there's an independent professional firm like us and the other good firms which are out there.
yeah,
You pay them a professional fee. And I think ballpark, and I can tell you what sort of the average numbers are, but ballpark, they should be considered the same sort of fee levels as a good accountant or a good lawyer, because
right.
they are equally as valuable, if not more valuable in many instances. And they're very, very important and they're integral to your life. And they're keeping you from making dodgy, bad decisions or, blowing up your financial plan or whatever. So you pay them a fee. The predominant fee model is based on a percentage of your pension fund or your savings. The average, last time I looked, the average in the UK is about 0.8, I think it is. So under 1% of your funds, you would pay an advisor for the independent advice, planning, tax structuring, all that good stuff. But then you've also got to pay a fund manager to run the funds, to manage your money, because most financial advisors don't do that. Or in fact, even if they do, they themselves are using funds. So the sort of names you might have heard of, like Vanguard and BlackRock and all these big institutions, here's where you should really focus on getting the fees low. And you should be looking to pay no more than about 0.2%, 0.2% for those investment funds. And that's where you're going to, as we were sort of talking about earlier on, the kind of low cost index funds. If you're talking about the sort of big active type funds, I mean, for example, and I don't want to decry them, but there is the largest wealth management company in the UK who've been in the news a lot recently. And one of the reasons they've been in the news is because their fees and charges were considered very expensive, and it had all sorts of penalties and lock-ins. If you wanted to leave them, you had to pay a big chunk of money to leave them.
Yeah,
they're finally joining the 21st century, and I understand they are, and they're not the only one. There's a lot of companies out there, but be careful about overpaying for fees. But if you can get the whole thing wrapped up for about 1 to 1.5% in terms of good quality independent advice, investment management. And your funds sit on what they call a custody platform, so they're safe and secure and all that stuff. You pay a few percentage for that as well, but 1 to 1.5% would not be unreasonable. And a good financial planner, they'll be worth the weight in gold. Honestly, you'll get 10 times back that as a return.
I know. Sorry, this is really personal, but at the end of the day, though, if you get in sort of, if you whatever the pot is,
Yeah.
you have a sort of pot size that you'll only deal with because you're in London and you've got a Ferrari outside the front door.
I haven't, but yeah. Well, we've got a minimum fee level just because you got to set we're very much self-styled boutique business. We're not a mass market business.
Sure.
We do work to help sort of the mass market. I think technology is going to help a lot of people, but we're not designed. We're designed to help people with bigger problems, if you like. So yeah, we've got some minimum fee levels.
Yeah.
But there's plenty of good advisors around, depending on circumstances, and that's a key thing as well, because it's perhaps second only to choosing a spouse. Choosing a good financial planner is important because they're going to be in your life, ideally. I mean, for years, for decades, they're going to see you through your retirement and beyond. So you've got to think: have they got all the credentials? Are they a good firm? I mean, the badge you want to look for is a chartered firm, like a chartered accountant. So my firm is a firm of chartered financial planners. Yeah. So again, no guarantees, but it's a bit of a filter. Are they independent? That's the other thing you want to consider, because lots of firms are what they call restricted. So they sell a restricted range of products and services. Yeah. And once you sort of did your research and found out the better firms in your area, it's back to trust your gut, finding an advisor. What does your intuition tell you? Do I like this person? Do I trust? Do I respect them? Do I want to meet with these people on a regular basis? But I enjoy that, or I think, I mean, we all know that. We've all met people who think, I don't mind if I never meet that person again. And there's others who say, no, nice, I enjoyed the conversation. I'll be very happy for them to be my advisor. So that's the process to go through.
Many episodes ago, we had a gentleman on the show who was really advocating self-administered pension schemes and suggesting, hey, you should be taking these things out. You should be running them yourself. Yep. You should have a financial advisor or so on helping you, because look at all the fees that they just take. They're just reducing your pot. What would you say to that kind of advice?
Well, that's classic vested interest advice, isn't it? Did this gentleman represent a company that sold self-assessed, what do you call it, self-administered pension schemes? Look, like a lot of things in life, you get what you pay for. Ultimately, the customer and the client is the judge of whether value is being received or not. But to say, oh, look at all these fees, assumes that the advisor is not adding any value.
Yeah.
And now here's the thing nowadays is fees are fully disclosed. Clients get every year, you get reminded how much you paid for it. And at any given time, you can say, I'm not getting any value here. I'm going to switch off. You can switch the fees off at any time. Yeah. We've never had that happen to us. But no, it's a misunderstanding to say, it's like saying, oh, you imagine? You should never eat out at a restaurant. Imagine if you go to a restaurant, think of all the money you got to pay. You could just stay at home and make a cheese sandwich. Of course, there's always the alternative. But here's the thing: there's a lot
You
of
obviously know a lot about Kevin Appleby, don't you? He hasn't been seen in the restaurants in Newcastle for years.
Kevin Appleby actually refuses to eat out for Sunday lunch because always reckons the Sunday roast is better cooked at home. It was always better than
I think that's fair enough.
Maybe that was the wrong analogy, but the point is, a good advisor, there's so much more that they will do, and it's, as I say, it's not just the finance. The finance bit is almost the table stakes. Of course, they're going to give you good quality, independent advice. Make sure you're tax efficient. But here's the biggest thing, and perhaps maybe even the biggest takeaway from this whole conversation is, us human beings, we're not rational when it comes to money. Money is a very emotional subject, and there is, and I'm just. Nowadays, but back to this thing, everyone's got an opinion. Your guy, selling his pension funds and stuff has got his opinion. Opinions are perfectly fine. I'm driven by data, facts, evidence. There is an unlimited amount of research, and you'll probably be aware of it. Daniel Kahneman died a couple of weeks ago. He was sort of godfather of behavioral finance. We are not wired correctly to look after our own money. Because of the fight or flight mentality. So this classic thing, the stock market falls 20%. Data proves every single time the amount of people that then sell their funds. Market's down 20%. I can't stand this. I'm selling out. I'm therefore crystallizing that loss. Whereas if you got somebody like a coach, a financial advisor, someone sort of talking you down off the ledge and saying, hang on a minute, let's have a look. Every time this happens, it always bounces back. And by the way, you don't need the money for another 10 years anyway. Let's just sit tight in the market. Sure enough, it recovers. That's just one example where an advisor would pay his fee 10 times over. So it's not in the funds or the performance, although they should be delivering something positive than that. It's the behavioral coaching. That is so valuable because, as I say, I know and I work with a lot of super smart people, but we are all prone to make big mistakes at times of maximum emotion. If you're 6 months away from retirement and your pension pot falls 20%, you're going to go panic. You're going to worry about it. And who are you going to speak to about it? You're going to know one to speak to about it if you're DIY.
I'll just ring you up.
Feel free. I'll talk you down off the ledge.
Yeah.
Don't do it. Don't do it.
No, I wouldn't. No, but you are right. The natural instinct is, what the heck should I do? But the right thing to do, it's like my Tesla stock. I have a Tesla outside, and I but not particularly because I've got that. I've got stock, and I've got stock from various funds. And Tesla's a big feature in it. It would be. So basic, but it's lost a fair bit of money in the last 6 months.
In some ways, I'm not surprised because I've never quite figured out why the market capitalization of Tesla, when it's a relatively small manufacturer, is nearly equivalent to the market capitalization of the whole of the rest of the car industry.
Well, it's because, I don't know. It's a separate conversation. Next week's guest is Elon Musk, and at the end of the day, I'm sure he'll answer it. But the truth of it is that there's probably a lot of different views about that. All I'm trying to say is that Alan's made a really good point about almost like, I think you, in your tweet, Alan, you said, and you can keep them in their seat. In other words, they don't go dashing.
That was my one today, wasn't it? Yeah,
it was.
exactly.
Yeah, I was looking at that. I was thinking that is really clever stuff. I mean,
so that's a very simple example that you can. There's a range of investment portfolios you can have. Very, very simply, the classic is 60-40. Yeah. So that's what most people have got. And if you've got a pension fund and you never paid much attention, it's probably in that. It's default, which means it's 60% in equities, 40% in bonds. So 60% in growth assets, 40% in defensive assets is effectively what it is, which is fine. And it's decent, medium risk, etc. And all I was saying, looking at data, if you just nudged it up, instead of 60-40, moved to 80-20, so 80% in growth, 20% defensive, the returns you'll have had from that extra boost on the growth assets were, I can't remember what the numbers are, but they were massive. Now, of course, if you went 100%, they were even, incredibly, obviously, I'm quite selective on the data there over time. Over the last five or 10 years, the equity markets have done pretty well. But this is the point. And that's why, again,
I think you were making the case over 20 years. The difference, you'd end up doubling your portfolio.
Yeah,
So
you would, but this it's kind of the question is it's all a roller coaster. Which roller coaster do you want to go on? One's a bit
yeah,
more bumpy than the other. You want a nice smooth
yeah,
ride?
yeah,
Absolutely fine, but you will get a much lower return in future. And if you look at those numbers,
yeah,
imagine the difference between that's the difference between a high quality retirement and a very mediocre one.
sure,
And
absolutely.
see that's what I'm saying is the value that a really good financial planner does is by coaching and explaining those things and saying, look, just so you know, it's not if, it's when. There will be a time during our professional relationship that your portfolio will fall 10%, might fall 20%, even more. But
Mhm.
here's the thing, because all roads lead back to the plan, as I said at the beginning, we know we're not touching that money. So who cares? In fact, if anything, if the market goes down, it's a chance to throw a bit more money into it while prices are low.
Alan, I'm absolutely amazed at the amount of time and that you've given us because like my daughter, she charges for every 6 minutes, and to get all this extra time out of a chartered financial planner is amazing. Honestly, the other thing about Alan, he's got his own podcast which is called Bulletproof Entrepreneur, and you can't go without just saying who does that serve and why should people listen?
Yeah, thanks for mentioning it. That's designed for business owners who are at or close to planning to grow the business and sell it.
Yeah,
I was always very interested. A lot of the clients we work with are exactly that. So I'm interested in the human journey. And again, the financial bit is interesting. How do you scale? How do you get maximum value for
yeah,
money? I mean, Kevin will be an expert on that sort of stuff.
yeah,
But what about the human journey as well? So, the person that goes through a sale and exit, they're now, wealthy. They've got significant liquid cash, but they're no longer a business owner. So what is their
mm,
personality? Because most business owners, their entire personality is wrapped up with the business ownership, and they're sort of no longer. And the same actually would apply with your business owner or not.
yeah.
Retirement is a similar type of thing as well. The thing that you used to do for 40 years, you're no longer doing. So the audience is business owners scaling towards an exit and life after.
Yeah, and life
If
after
I
their
could just
wives, no doubt as well, because I think there's a lot of divorce just after business
There,
set.
there, there absolutely is. And that's some of the things we want to explore. You want to be prepared. Most people spend a lot of the time, again, back to Kevin's point earlier on, a lot of
Mm.
the time on the financials and the numbers. How can we make this company worth more? But what about, the wife, the kids, or the husband, or whatever it is? So
Mm.
how is that working out? What are they hoping
Well,
to achieve from this?
I know a brilliant lawyer who can help you if you're in that circumstance, and she'll do a grand job for you.
That's a huge, huge rate of money for every 6 minutes.
Yeah, well, no, well, yeah, if but like you said, if you're working for a good firm, then that's what you have to charge. But Alan, you've been an absolutely top guest.
Thank you. I've
I'm
enjoyed
sorry,
it.
Kevin, misinformed me about your accent. I mean, what can I say? I mean, you did
That's
sound
fine.
like you're from the southwest, but
Southwest Scotland, we got it right.
yeah,
Yeah, and your
we,
Scottish
yeah.
accent's about as well hidden as my Geordie accent.
There you
Well,
go.
I don't. Yeah, I can tell you're a Geordie, Kevin. So
How
a
I,
posh
Graham? Of
Geordie.
course you
Just
can.
know we know where Graham's from, that's for sure.
Well, that's for sure. Anyway, right. Well, actually, I'm actually half Glaswegian, believe it or not. So there you
Which
are.
half?
Um,
Yeah.
well, I think my
The
Wrong
top
mum's
half.
half.
from. It used to be not quite as, shall we say, a fighter like now. But she was from Rockhill, but basically, it used to be quite a pleasant place, but not so much.
Yeah, I haven't been
Not
for a
so much
while.
now. Anyway, but on that note, Alan, thank you again for joining us today on the next 100 Days podcast.
My pleasure. Thanks for having me.
Graham, approaching 65, puzzling about all these things you can do. And you and I have had the conversations around that on several occasions.
Yeah,
One of the reasons we got Alan on the show. Do you feel you've got any more clarity?
I do actually. It, it, Alan's a really compelling individual. I knew he would be because I've been following what he says about financial advice and so forth on Twitter, and he makes an awful lot of sense, and that's the reason I originally reached out to him. Now, for me, the one thing that he mentioned that I really should have is the plan. Now, we've been kind of formulating that, um, but to his point, there'll be a lot more questions that other people or the plan would ask than we would have formulated. So, yeah, I mean, that's as a starting point, Kevin, that's really helped me.
Mm.
As far as the investment thing, what was interesting was how he's and in one of his one of his tweets, he's detailed exactly how he's investing for his fortress returns.
Mm. So yeah, I think the interesting thing for me was Alan saying that this is an art and not a science.
Yeah,
And I think I'm going to be actually very interested in starting to follow Alan, and I think I'm probably going to start listening to his podcast as well.
yeah.
Um, Actually, funnily enough, one of the things I've done very little since lockdown, I used to listen to loads of podcasts. The number that I listen to has dropped immensely because I just don't spend the time in the car anymore or things like that.
No, that's true, but also you're also recording plenty, and you
Yeah,
shared before we started this recording that together with your Growth CFO show that you've done 600
yeah.
podcasts, which is amazing, Kevin. Well done on that achievement. I mean, I've I've been
How anybody's listening to this because
well,
I've issued a couple more.
well, we've done 400 and odd, and I know that we've done that as a pair, but on the other one, you're doing it singularly, and so therefore you have a sort of a two ways of looking at a podcast sort of thing. And
Yeah.
Alan himself told us after we stopped the recording that he has another podcast called Trap, where he's there with three other financial planners, and they're all mates, and they basically just shoot the breeze for a bit, and it's great listening.
Mm, yeah. So certainly I'm going to start listening to Alan, but I think some great advice there from Alan. Certainly
Mm.
the one that comes over to me is that plan. I've never sat down and thought about that plan at all.
Mm. Yeah, I've done one and one before, but yeah, it's overdue again, and I think I'll get to that, and I think there are a couple of resources on Alan's capital.co.uk site, so that might be a good place to start. So, well, today I've been Graham Arrowsmith.
I've been Kevin Appleby. Goodbye.
Goodbye.